Hello, my name is Richard Foster. I'm a current resident of Longmeadow. And joining me today is another Longmeadow resident, Mr. Joseph Martins. You may have watched the first session by now, but Joe has been gracious enough to come in and do three different sessions on home ownership, financing, refinancing, a whole variety of subjects. I believe you'll find these sessions informative and enlightening as Joe explores a variety of issues and concerns that possibly a normal homeowner like myself is not considered until after we've gone through the experience. And by that time, sometimes it's too late to have made the mid-course corrections that we need. Today's session is going to deal with refinancing and refinancing for renovations or homeowner loans or home improvement type loans. Joe's going to be talking about the difference between the types of financing and a lot of pieces of the puzzle that you should consider before entering this arena or as a precursor to going into this adventure. So with that, Joe, I'm going to turn it over to you and let you start talking to us.
Great, thank you, Richard. The refinancing process, if you recall or have watched the previous episode about home financing in general, the refinancing process is very similar with some additional documentation. And in the first episode where we talked about putting together a folder of documentation, your income documents, your asset documents like bank statements and so forth, to that we need to add a few documents for the refinancing process, particularly if you own additional properties. This is going to be important, and that is the property tax documentation for the most recent document that you have. If you don't have a copy, usually the lender or yourself can obtain one from the town. The insurance, the homeowner's insurance declaration page showing the most recent premium paid, it's basically proof that your house is covered under homeowner's insurance, and the mortgage statements for those properties. And in the last session, we didn't have an opportunity to really get into this, but what is important is that all of the figures for how much you pay on taxes, how much you pay on homeowner's insurance, how much you're paying on your principal and interest for those mortgages, that's all taken into account as part of this thing the industry calls the debt to income ratio. It's basically adding up all of the different debts that you incur on a monthly basis, typically mortgages, auto payments, credit cards, things of that nature, and then dividing that by your adjusted gross income to come up with a percentage. And that percentage helps them to identify what programs you'll be eligible for, what kind of financing you can accomplish. And generally, it depends on the program, but in the low 40s, 41, 43% is around the maximum that a lot of these programs have for debt to income. And you can do this back of the napkin math yourself if you add up those different costs and divide by your adjusted gross income. The only thing not included there in most conventional financing is the utilities. Your electric bill, your gas bill and so forth, that's not considered part of those debts. So focus on your tax, your insurance, your mortgage payments, your credit card payments, your auto loans, student loans, things of that nature are what makes up the debts in the debt to income ratio. But those three documents, tax documents, your mortgage statements, and your insurance declaration pages, put those into your folder of documentation that you would provide to a lender in order to understand whether or not you can, what is your financial footprint for refinancing.
And I guess what you were saying, some of the obvious steps a homeowner could do is to reduce some of the debt, if possible, before going into this process, to get this ratio in a more positive light. Is that correct?
Yes, and the best way to go about doing that is to, when you speak to a loan officer, doing that preparatory activity that we talked about last time, they will be able to tell you the best way to go about doing that. A lot of folks will think, well, maybe I'll just cancel that card. That has to make my situation better. Not necessarily. Cancellation of a card can result in a massive drop in your credit score. You need to understand what types of payoffs, payments, pay downs that you can do with your credit in order to make your situation better, not worse. So don't rely on your intuition. Get it straight from a loan officer so that you can understand which pieces of your debt you need to address in order to successfully finance. The great news may be that they assess the situation and determine there really is nothing that you'll need to do. You're in a good position now to be able to accomplish, and that's great. But getting that documentation package together, and particularly for homeowners, existing homeowners, putting that additional documentation in, it means fewer calls to get other documents that we're missing and so forth. It speeds the process up and makes it a lot less stressful. One of the other things I did not mention last time, but I think it's important to understand, a lot of borrowers get stressed out by the repeated requests for documentation. It's tough to swallow. You provide documents that you were asked to provide, and then 2 days later you get a call, we need more documents. What's going on behind the scenes is you're submitting the documents that represent probably 90% of what you'd really need to submit for that loan. Then they're reviewing it, and usually during the review additional questions come up. Other documentation becomes required, and that can occur repeatedly. You have to take it with stride. It's nothing personal. It can be difficult sometimes. They may ask for documents that you're not comfortable with giving. For example, if there was a divorce, they're going to want to see the divorce decree. Not because they want to pore over the details of the decree to see your personal life. What they're looking for is any kind of financial obligations that might affect your numbers. And that document may lead to a request for an additional document. The way that I tell people to approach this as a borrower is just fulfill the request as quickly as you can and wait for the next request and hope that you get to a point as quickly as possible where there are no more requests, where you've now fulfilled all requests and they can move on and complete that loan. But until then, just don't let yourself get stressed out about it. A lot of people do have to give documentation multiple times throughout the process because of that footprint that we talked about. Each individual has a circumstance so special that we don't know in advance all the documentation that you'll need. We might know 80, 90% of it, but there's always those few documents that we'll need in addition.
Okay, I have a question, Joe. We talk about, it is credit history. I mean, we're developing a credit history, and I'm not sure if it's still current today, but when I grew up, it was beneficial to have credit cards. It was beneficial to have something that you were paying that shows your pattern of history of paying off something on a scheduled basis and not going into default on anything. Is there any difference between having an account that you pay off at every month as versus the one that you carry a balance on as far as credit history development?
Well, so first thing to understand is that your credit profile includes many different types of credit. So for example, a store card isn't quite the same as a traditional credit card, isn't quite the same as an auto loan or a student loan or a mortgage. Those are all different types of credit. When a credit reporting agency looks at your scoring and so forth, they have this mysterious black box into which all these different kinds of payoffs or payments are going into, and that is what helps them produce a profile for you. Now, when a lender is looking at your credit history, typically they want to see about 3 to 4 what they call trade lines, meaning a nice variety of different kinds of credit. Maybe you have a student loan, an auto loan, a mortgage, and a credit card. Or maybe you have 2 store cards and a traditional credit card and a mortgage. Those are all representative of different kinds of trade lines, and what they'll do is they'll look at the history of the credit history of those trade lines to see if it's in good standing, how many late payments, and so forth. Any anomalies. Was there an extenuating circumstance, bankruptcies, judgments, anything that might require additional explanation from you or might need to be addressed before you can even close a finance, for example, a judgment. If you have an outstanding judgment, the lender might say you are required to pay that judgment off in order to even obtain financing. That's all based on the rules that all of these lenders must follow in order to qualify you for that mortgage. Now, if you don't have enough trade lines of traditional credit sources, they can use non-traditional credit, which means basically going back about 12 months into your payment history for other types of debts. So for example, rent. If you've been renting an apartment, they might want to look at your bank statements for the last 12 months to determine that you did indeed cut a check to a particular landlord and it was done on a timely basis.
Right.
Your utility bills, that's another great example. But they need to see that history. What happens sometimes is you'll get a borrower who is an excellent, in terms of paying things off on time, they're excellent with it, but they're doing it with cash. That's a problem because there is no paper trail, official, accepted, legal paper trail for a lender to refer to when saying, is this a viable, non-traditional source of credit?
Right.
So for me to say, well, you know, I've been paying my cell phone bill with cash every month for the last 12 months, that's not going to work.
Right.
So what I advise folks is make sure that you're using a form of credit that is easy to track. They can look at your credit history, your credit report, they can look at your bank statements and see the payments and see the history of it from those sources. If it's not on there, it doesn't exist.
Okay. Well, that's a good takeaway tip on credit. I'm glad we proceeded further in that conversation and brought that point out. So you've got a credit history developed now, and you're in the process of refinancing. What's the next step?
So if the first step would definitely be having that conversation with the loan officer. I know you hear it from me repeatedly, but it's because that's the preparation step. Making sure that you understand your financial footprint in order to kick things off. If you find that you're told you're good to go today, your situation is such that if you wanted to refinance today, you could do it. The next thing is look at all the different options. For example, I mentioned in the last episode, making home affordable. There are folks out there who still have loans that are Fannie or Freddie, meaning Fannie Mae, Freddie Mac, that were closed prior to June 1st, 2009, and they may in fact be eligible for streamlined financing, meaning that if they show a couple of documents to the lender who currently has their loan, that they may in fact be able to refinance rather quickly using the Making Home Affordable.
Let me ask you, is this something now that I would have to tell the lender, or would the lender research this and know this in advance?
They will know it, but they're not going to proactively tell you. And it's not because they're trying to do anything underhanded. It's simply because they would have to actually have gone in, let's say, and researched it and then proactively sent out notifications. In some cases, that has occurred. Folks have received mailers that say, hey, you're eligible for refinancing from their lender. Make sure it's not, if it's from another lender, it depends on how they got the information and what their objective is. But your own lender, if you're eligible through that program, you'll be able to make a simple call, speak to a loan officer, and just say, could you look up my loan information and see if I'm eligible for that program? And they can look it up and tell you right away.
Okay.
If you are, it's a great program. Not only is it a lot less documentation and a lot less inquiry today, at least under today's rules, than traditional refinancing, but the rates are relatively great relative to available market rates today. And in terms of a process, there's a reason they call it streamlined. It is indeed a lot faster and easier from the borrower's perspective to do. The lender still has to go through dotting the I's and crossing the T's. The other thing to keep in mind is if you're not eligible for that program, it doesn't mean that you can't obtain refinancing. You would just have to go through whatever other methods are available. For example, a conventional refinance. Going through the regular process, almost as if you were purchasing a home, where they check your income your assets and so forth, go through all the motions and make sure you're eligible financially for a conventional refinance.
Okay.
But it is worthwhile to check why. A couple of years ago, rates continued to go down. It was a phenomenal environment, but people kept waiting. They were waiting because they said, well, the rates are at this today, and if I wait a couple months, the rates will go down. That turned around several months ago. Anyone looking at the market now would have noticed that the general trend has been upward. No one knows what the next 6, 12, 18 months hold, but generally for the last several months, rates have been going upward. So the longer someone waits, the less of a benefit they're going to get from refinancing. If I'm at 6.5% today and rates are at 4.5%, and I wait 6 months, there's no telling. But the general trend would point to the fact that those rates might be much higher and closer to what I already have. And at that point, is it really worth refinancing?
Right. Now, it used to be, I think it was 1% difference between.
That's a ballpark.
What is that still a ballpark figure?
That's still about a one. I mean, you know what that depends on highly? The property.
Right.
A 0.25% on a $2 million home can be a substantial amount of money.
Right.
1% on a $200,000 home may also be a substantial amount of money for that borrower. So the general ballpark is about 1%, but it really depends on the borrower and the property and the rate they're in today versus the rate that they can get into and the program that they can get into. One of the things you want to watch out for with refinancing is this. When someone had come into me to, let's say they were 10 years into their 30-year loan, so they only have 20 years remaining, and they're at 6%.
Right.
And they wanted to know, can you lower my payment? Or can you lower my rate? The first thing that a really experienced LO will look at is, well, can I do it in such a way that I'm not putting them back into a 30-year loan? They've already paid 10 years off. Why? Of course I could lower their payment and lower their rate if I put them into a particular longer loan, but then their cost of interest and the length of the term is longer. The question is, if I have 20 years left, can you refinance me into an equivalent 20-ish year loan at better terms? Because now your payment may go down and you're not going to increase your term at all.
Right, you're looking apples and apples.
Apples to apples, absolutely. And then the other thing is looking at the APR versus the interest rate that typically gets quoted. Lenders are required to disclose the APR as well, so they have to tell you both. But if you really want to compare apples to apples with any kind of financing, buying, refinancing, you have to look at the APR. The reason is that includes all the costs associated with doing that financing. So I could tell you this is a 4% loan, and another lender could tell you that this is a 3 7/8 loan, but my loan might be a 4 3/8 APR, and theirs might be a 4 5/8 APR. And you have to look at that and say, well, I'm comparing the APRs. Which one's higher?
Sounds like we're starting to get pretty technical into that.
Yeah, so my advice there would be, rather than trying to go become a loan officer online and educate yourself to the extent that they have to, it's have a conversation with them. When I was doing origination, I walked through as many different scenarios as they wanted to go through until they felt comfortable that they were making the right decision. And that's really important. Rely on their expertise. They'll run the numbers for you, and then you can make a decision based on what you're seeing on paper.
I can remember something that used to be general advice, and I'm not sure it's still current, that quite often you were better off to take a 30-year mortgage, even though you could afford a 20-year mortgage, because you had that escape route in case something financially happened in your home and you had to go back to a lower payment, because you can always prepay and change the years on your mortgage. Is that still a viable thought process?
Yeah, one of the things you want to discuss with a loan officer is your goal. If I, for example, heard that you were looking for enough of a financial buffer such that if things happened, if I lost my job, if I had to take a cut in pay, how would I be able to afford that 10-year mortgage? Now, let's say you can today financially afford a 10-year mortgage's payments, but you take a 30-year and pay it as if it's a 10. So every month, let's say that 10-year, the monthly payment's $2,000, and let's say the 30-year is $1,000. I'm just throwing out numbers, but let's say it's $1,000. That means you are on the hook for 50% of the amount. You only are on the hook for $1,000 each month. Yes, if you were to stay in that loan for 30 years, never refinance out of it, you're going to pay all the interest that comes
Right.
with. However, if you pay the extra $1,000 every month because you can afford to right now, onto that principal, and you make sure that the lender knows that that separate payment you're making is for the principal, that at the end, if you do the math, and you can use a calculator online, it's called an early payoff calculator, it will show you that it'll end in approximately the same amount of time, 10,
Right.
11 years. But you're not on the hook. So if 5 years in, something happens, and you financially couldn't afford the $2,000 a month payment, wouldn't you be a lot happier to know that you built that buffer in yourself? The rates will be different on those terms. The 10-year might be a little bit cheaper interest
Right.
rate and so forth. But again, you have to look at it as your plan, and what will work best for you. What do you feel most comfortable with, and go with that. If you want the 10-year, absolutely. I mean, you can do it, but just remember that obligation
Right.
is going to be significantly higher.
Well, and I thought what we wanted to leave the people was that is an option, a very viable option.
Absolutely.
It's a safety plug, especially if you're starting out and you don't know what the future is holding for you. And there gets to be a lot of confusion on prepays and all this. And you had an excellent point. The fact is, make sure that the lender is aware, and it's in your loan document, that any prepayments made goes towards the principal.
Yes, because one of the things that can happen, and it's not because they're trying to do something underhanded, but when you send an extra payment in, if they don't know that you want to apply it to the principal, they can just simply assume that that's next month's payment being prepaid. At that point, you've paid ahead. You haven't really paid down your principal. So make sure that they are aware, and you can usually talk to the lender and ask them what their process is for prepayment, and if it means writing an account number and the words prepayment on the check, follow that process to a T, and make sure that it's applied to your principal.
And make sure there's no prepayment penalties.
Absolutely. Most of the programs don't have them, but there are programs out there today that the terms include prepayment penalties. So you definitely want to make sure that you're aware of that in advance. And you'll notice that today's documentation versus, say, 10 years ago discloses a lot of information.
Right.
So if you're going through that documentation and it just doesn't make sense and it looks like a foreign language to you, take it to the loan officer, and they will walk you through that documentation for as long as is necessary to help you understand what you're signing into.
And I think that's an important part, because a lot of people, when they're first starting out, are not thinking about what you and I have just chatted about. They're not realizing that they can do prepayments, for instance, and drop their loan down and change a 30 into a 10. Sometimes by just making a minor contribution to that loan every month, because it's going against the principal.
$100 extra each month, if you can do it, is against that principal. It's amazing. It can cut, depending on your loan, your terms, where you are in the process, it can cut years, 2, 3, 4 years off of your loan.
Yeah, $100.
And in terms of interest, that can be many, many thousands of dollars in interest that go away. I mean, prepayment is a very powerful tool. One other thing I should mention is that folks will hear about biweekly payments, basically meaning that instead of 12 payments that occur throughout the year, there's a payment occurring every 2 weeks. And if you think about it, 52 weeks in a year, that means 26 payments. Essentially, biweekly payments is the equivalent of 13 monthly payments in a year. So you're basically putting a month's payment toward principal every year in addition to your normal 12 months. It's just divided up in a different way. You can do that on your own. You don't have to sign into any special program where you pay a fee. I've heard of people getting approached by lenders saying, for $3.50 a month, you can get into this program. And no, you can just send in, for a lot of these lenders, a payment, mark it for principal, and it's achieving the same goal. Whether you take that 13th payment and send it at the end of the year, or send $100 extra every month, however you want to divide it up. So
I think the main point we're trying to bring out is there are a lot of things that you should investigate when you're refinancing or when you're buying a new home. Also, is when you're setting up the finances for that. It's not a straight, clean-cut process. There's a lot of variables that you can fold over to change the end of the road. So now this is strictly refinancing. Is there another piece of the puzzle after we get our loan officer going?
No, it is a traditional financing process, as if it was a purchase with no purchase and sale, of course. You know, it's already your home. So they go through, they check all your documentation, ask you for any additional documentation, and go through to the closing of that loan. Now, one important thing to keep in mind, they have something called, the regulations allow for something called a right of rescission, which basically means that after you sign those closing documents, you still have 72 hours to change your mind. You can get out of what you've signed into. If for whatever reason you want to, you can get out of it in that 3-day period. You call up the lender that you were doing your financing with and you say, I want to exercise my right of rescission, and they will undo everything they did. Just understand that that means that you're back into your original terms. None of what you had worked on applies at that point.
Okay, that's for refinance. Does that also apply to the original home purchase? Do you have the 72-hour period?
No, it's the refinance.
It's the refinance. So, and is that federal or is that a state law?
Federal.
Okay.
Yep. And that's why you'll see it's across all lenders. Many of the rules that lenders follow are, you have your federal level, then you have the individual state levels, and then you have the investors' rules, and then the lender themselves. So at many different levels, there are a lot of overlapping guidelines, and that's why, relying on, let's say, what my dad tells me happened in his financing situation 6 months ago isn't generally helpful, because rules change, terms change. You have to think of things in your context for you as an individual. And while some of that advice may actually be accurate, just understand that a lot of what you're hearing may not necessarily apply to your circumstance. The only way to know is speaking with the actual lender.
Now, there's a couple more things. Of course, when you go into the refinancing arena, you may be the lender may ask you to get an appraisal on your property again to make sure it's clean, titled. So there are some expenses involved in refinancing, but above and beyond that, we hear this expression all the time, points. What are points?
Generally, every rate that you're quoted comes with points associated with it. It's the cost, essentially, of getting that rate. Now, typically, when you're talking to a loan officer, they might just naturally tell you the rate that's available as 0 points, meaning it costs you nothing extra, costs the lender nothing extra. It is, if I said 4% at 0 points, that is a rate available to you with no points attached.
Right.
However, you can ask that loan officer, well, could you show me the other rates available to me? And what they will do is show you a table of rates that go above and below that rate. So I might show you 3.5%, 3.75%, 4%, 4.25%, and 4.5%. Each one of those are going to have points attached to it.
Right.
The point, 1 point, is equal to 1% of the loan amount.
Right.
So if it's a $100,000 loan, that's $1,000. That's what 1 point is equal to. And half a point would be 500 and so forth. That's the cost of that particular rate. Now, the terms you'll hear are simple. One is called buying down. That means that I pay a certain amount of points to buy down to a lower rate. So if I'm quoted 4% at 0, but I can buy down to 3.5% at 2 points, on a $100,000 loan, that means I have to pay $2,000 extra at closing to get 3.5%. My recommendation, have a loan officer work out the costs with you so that they can show you what the interest cost difference would be, what's the monthly payment difference. 3.5% might mean $12 on your monthly payment between the 4% and the 3.5%. Do you want to pay $2,000 out of pocket to get a $12 savings in your monthly payment.
And how many years would the
And how many
payback
years,
be?
exactly. So they can run through all those numbers with you, but just understand that it's not a single rate available to you, it's a whole schedule of rates, and you can actually look at each one and decide what works for you. In the other direction, if someone has trouble financially where maybe they're not able to come up with the monies that they need to do their financing, before I said buy down into a lower rate. There's also premium pricing, which means you take a higher rate than the rate at 0 points, and the lender contributes to your costs the amount in points. So if 4% is at 0, and the lender says, if you take 4.5%, I will give you 2 points toward your costs. That means on a $100,000 loan, $2,000 contributed for you to do that financing in exchange for taking 4.5%. So there's a give and a take. If you want the better rates, you pay down to those rates. If you take a higher rate, you can get some benefit for those who might need a little bit of assistance in being able to close that financing. But points aren't, again, it's 1 point is 1% of the loan amount. So it's pretty straightforward to calculate, and a loan officer would go through that with you,
Right.
to explain them.
Okay. It's also my understanding that all agencies, financial institutions, do not have the same points attached to their loans.
Exactly. 4% at one institution might come as 0 points. 4% at another institution might be available at 1/8 of a point. There's a difference. Now, you can still talk to that lender and say, hey, can we work with this? They might have enough leeway where, who knows, they might be able to waive a fraction of a point. I wouldn't have an expectation that they're going to be able to waive a lot, but sometimes it can be several $100s. I have had occasions where I had waived a portion of a point, and it could result in a several $100 savings to that individual for that particular rate.
Right.
So you speak with the lender and see what they can do for you, understanding two things. One, remember, that's that quoted rate, and then there's the APR.
Right.
The more you can lower the cost of doing that loan, the lower your APR is going to be, and the better deal.
So there is a given amount of negotiation that can take place in any financial deal, but you're not sure what the limits are. Another question.
One thing I should point out really quickly is some of the fees are non-negotiable.
Right.
They're not set by the lender.
Right.
In fact, quite a few fees. They have to do with the appraiser. They have to do with the federal government for
Right.
recording the loan and so forth. So there are fees that are absolutely non-negotiable for anybody. And then there's a little bit of wiggle room beyond that.
Okay.
So
I'm going to ask you a question on the dark side. Are there any fees that you've experienced during your career that you would consider just add-on type fees? Fees that maybe one institution charges that nobody else charges, and it's kind of a nuisance fee.
Maybe in the past. These days, because of the regulations and the environment post 2006, 2007,
Okay.
after the collapse of the housing market, there was a lot of tightening of what you could be charged. If you're quoted in your good faith estimate a certain amount, there can only be a certain amount of variation in your final documentation, and only of certain fees. So a lot of lenders are bound, if they quote this on a specific fee and the government does not allow any variation, at the close of the loan, that number will match.
Okay.
So if you were quoted 100, it will say 100 on your final. In certain aspects of the fees, they're allowed a little bit of wiggle room, 10%, where you might be quoted something at the start of the app, but it might be 10% up or down at the end of the process when you're closing. And they're allowed to do that because there are certain things where you can't predict the interest, the daily interest on the loan. It depends on what day of the month you close.
Right.
So the government does allow for certain variation in the fees, but what you'll find is that for the most part, the fees will be the same. Types of fees,
Right.
the amounts. So appraiser amounts, you're not going to really see variation. An appraiser is an appraiser. That's an independent third party. Credit report. Some places charge more than other places, but the lender origination fee. That's probably the biggie.
Right.
Most lenders have an origination fee. One thing to be very aware of is when they say no closing costs or no cost, no down payment, you need to be aware of whether or not they're building those fees into your financing.
Right.
Because you can, when you refinance, you can do it all out of pocket. You can, if I tell you that the closing costs are $2,500, you can pay that $2,500 at closing yourself, but you can also roll it into your loan. What you don't want is for you to be under the impression that there's no cost,
Right.
but it's being rolled in.
Right. And if it's rolled in, you're going to be paying interest on it possibly for 30 years.
Yes, you're paying interest on additional funds that you're using to close that loan.
Right.
However, again, an experienced loan officer, what they'll do is they'll actually show you that even though, let's say you're rolling in $3,000 worth of closing costs today, you're getting such a good rate and such good terms that in the end, you've got a better deal
Right.
than what you're in. So that's where when I say we need to work through the numbers, it's not always easy to look at a set of numbers and say, oh, I know what that means. You want to walk through, see what does it mean in terms of return on that additional investment. You want to see what it means in terms of total interest paid, and what it means in terms of your life. Are you going to be in that home for 30 years?
Right.
Or are your kids 13, 14 years old, and in 5 years when they're out of high school, maybe you're looking to sell and go somewhere else. So now you can just ask the loan officer, could you extend these figures out to 5 years? And let me see what that would look like
Right.
around that time.
So essentially you're saying since 2008, the bubble, a lot of these practices now have been corrected. So the buyers, it's no longer truly a buyer beware. There's been a lot more regulations brought in to this process.
Yes,
To
and
protect consumers.
in fact, the CFPB, I believe, Consumer Financial Protection, is an organization that oversees a lot of this now. It's fairly newly created. And the goal is to kind of watch your back. Now, it can be a double-edged sword in that all the stricter regulations that have occurred since 2007 or so, that meant it was a little more difficult for some people to get the financing that they want in terms of having to show more documentation, provide more evidence in order to get the financing. Some people want to walk in a door and expect, maybe they bought their house in 1998 and they remember that process, the loosey-goosey days of
Right.
stated income, and it was so easy, boom, boom, I'm done. That's gone. That's gone. When you go in now, you can be certain that they're going to treat you just like the next person. You're going to be asked for the same kind of proof as the next person, depending on your specifics of your circumstances, and that's just the way it is. So the consumer protection is in place to make sure you get a good loan, that you get a good deal, but it also may mean that you need to provide more evidence and go through a few more hoops in order to make that happen. And in my opinion, I mean, it's worth it. It's a little more strict, but if you qualify, those guidelines are meant to be, well within, rather than putting you at the limit of your financial ability. It's designed to look at something where, what's the likelihood that this person's going to default? What's the likelihood that they won't be able to afford this long term? And so you can be a little more, have a little more comfort in that kind of financing.
Okay, I've refinanced and I've taken my savings, monthly savings, and I'm in the Bahamas. But my next door neighbor, when I left in the winter going to the Bahamas, he was talking about refinancing for a home improvement loan. Can you talk about that process? I understand those two processes are somewhat different.
Yes, because home improvement now, there are requirements that come along with wanting to do the renovations on a home, and it depends on how you go about refinancing to do home improvement. So for example, one way is what they call cash out refinance. It's pulling out some of the equity of your home in a lump sum, which you can then use to do whatever it is that you need to do. So for example, a child's education, or renovation on the property. It's just like the normal refinancing process, but just understand that there are limits. Rather than citing the many different limits, I'll just say that there are limits to how much equity you can pull out in a property based on the type of property it is, based on what your debts are, et cetera. They'll determine, let's say, for example, if you have 50% equity in your property, you can pull out up to 80% of the value, and so you can pull out about 30% of the equity that you already have in your property as cash to do whatever it is that you need. But understand that they're going to go through that whole refinancing process that we just talked about with all that documentation and so forth. But at the end of it, what you're essentially doing is getting a check to do whatever you need to do. Now, so that's one way. The second way is home equity, getting what they call a home equity line of credit. And it's very similar to the previous one in that you're pulling out equity that you've built up in your home. And there is a limit to how much you can pull out once again. The difference is it's a line of credit versus a lump sum of cash. So you're paying an interest rate like you would almost on a credit card. And let's say I get a $50,000 line of credit on my home. A couple things to keep in mind. The only time you pay interest is when you have a balance. So if you're not using it, you're not paying interest on it. But when you do have a balance on it, you're paying whatever the interest rate is, and on a home equity line, it's generally a little higher than what the equivalent rate would be for, let's say, cash out refinance. The way it works is this. Most financial institutions are like this. You have a 10-year period that you use it like a credit card. It's called your draw period. At the end of that period, if you have a balance, it goes into a 15-year repayment period where it works just like a regular mortgage. During the draw period, it's interest only. For a lot of institutions, it's just an interest only. Can be very appealing, but be careful that you don't run up the tab.
Right.
Because when it converts to the repayment period, you're now paying interest and principal on that. The other thing to keep in mind is toward the end of that 10-year period, you can actually go back in and ask to refinance again and basically restart the clock on your home equity line. So at 9 years, 6 months, you might go back in again, say, hey, I'd like to do a home equity line. They'll, if you qualify, they'll convert that home equity line into a new home equity line. They basically close the existing one, open a new one, and the 10-year period starts all over again. But closing costs with conventional cash out refinance, you have your closing costs, just like you would for any kind of refinancing.
Right.
Home equity lines generally have no closing costs up front. What happens is the lender pays the closing costs. But if you close that line within a certain amount of time, and at places that I've been employed, 3 years was that amount of time. If you closed it, then you'd have to pay those closing costs. So if it costs $2,500 for your home equity line and you closed it at 2.5 years, you'd be on the hook for the $2,500 plus whatever early closing fee that lender might have.
Sounds like it's getting technical again, doesn't it?
It does. And again, the best approach there is sit down with the loan officer and say, here's what I'd like to do as far as renovation. And they can say, well, cash out refinance makes the most sense, or a home equity line would make more sense. Or the third one, it's the one we haven't touched on yet, it's the renovation loan. The home.
I've never heard of the renovation loan. Is that a fairly new?
No, it's been, let's see, for FHA, around 3 decades.
Wow.
It's been around for quite a while. And there are other, it's not just FHA.
Right.
Fannie Mae has renovation loans. Mass Housing in this area has home improvement / renovation. Essentially what it is whether, if you own the house already, you're basically borrowing to improve the house. It could be because you want to sell it. And right now, the state that it's in, you wouldn't get the best price. If you invest $20,000, $30,000, maybe that price is now, the value is now $50,000 more than it was before. So from a seller's perspective, it's a great way, it's a great kind of loan to take out in order to improve on a property to try to get a better sale price on it.
Okay, well, let me stop you right there. You mentioned 3 different loans, and I'm sure there's benefits and pluses and minuses. And we don't really need to get into a massive amount of detail, but I think bringing to the attention of the homeowner that there's 3 different loans out there. And by the way, I was totally unaware about the last one that you mentioned. But is there any really quick benefits that you can say that would apply to each of those for somebody to have a takeaway without talking to their financial advisor?
Sure. Well, the home equity line is great if you're just looking to kind of use it on occasion to do, small improvements here and there, and you want to pull out that line. Just keeping in mind that if you sell the house and you have to close it before the 3-year mark, you'd have to pay those closing costs.
And this is similar to just having a credit card.
Exactly.
Or I guess you could say a gift card that's got $50,000 on it.
Yes, and paying interest only, during for that first 10 years.
So the first 10 years,
So
and that was a key point, because you're just paying interest.
And you can pay principal if you'd like. There's
Okay.
no prepayment penalty on paying principal.
Okay, good point. There is no prepayment.
No prepayment
Okay.
penalty on paying, but if you hit hard economic times and you can only afford the interest on it, you can do interest only during that period. But the thing that is nice about that particular approach is it's like a credit card, and you use it on whatever projects you need when you need to accomplish that. The renovation loan, it's great for folks who see a piece of property that would never qualify for conventional financing. Maybe it's in such a state of disrepair. Could be something as simple as the roof needs to be repaired, and the seller is unwilling to repair it and selling it just as it is.
Right.
That's not going to fly with a conventional loan.
Right.
So the lender will say, would you like to do a renovation loan? At which point you're basically borrowing for the cost of the house plus the cost to fix or improve that house. Some of the things may be things that are required. Must get the roof fixed.
Right.
Must have a kitchen that's actually operational.
Right.
Plumbing that works. Others could be, it's a house that you saw in a great neighborhood, has a kitchen from the 1950s, and you'd like to update the kitchen.
Right.
You can now borrow for the house plus improve that kitchen all in one loan at one rate. The other nice thing about it is with the renovation loans, typically the lender is sitting behind you in this entire process. Meaning, when you go out and obtain a renovation loan, that lender is going to require certain things of the folks that are doing the work on that house.
Okay.
So for example, contractors. Everyone has heard horror stories for dealing with contractors. Lenders require that those contractors are licensed and bonded in that state that they're doing the work. So you're at least assured that this contractor is on the up and up. I mean, while it's tempting to go on Craigslist and hire somebody, and they may be the best, nicest person in the world, the reality is that unless they're licensed and bonded, there's no recourse if something should go wrong. The other thing is that they usually, for example, FHA requires an inspector, a special inspector, HUD inspector.
Right.
Different from a home inspector. The HUD inspector's purpose is to make sure that that property qualifies for FHA financing.
Right.
So they're looking for anything that's a safety issue or other structural issues, things like that, that would make require to be fixed before that property could actually be financed.
And so that still holds true. The FHA loan is I always considered it a safer loan.
It has a lot of safety nets.
It has a lot of safety
I mean, there is an expense involved with that loan, but it has a lot of safety nets. Licensed and bonded contractors, usually on an approved list. There are some lenders that they say, these are the contractors we deal with. And the reason isn't because, washing one hand washes the other. It's because they know that that contractor is going to deliver. Okay. There are time restrictions. Everybody's had a do-it-yourself project in their own home that ends up taking 5 years. FHA says 6 months. Right. On a full FHA renovation loan, 6 months, all the work has to be done in that time frame.
Is FHA the only ones that issues home renovation loans?
No, Fannie, Freddie,
How about conventional?
Conventional won't allow renovation.
Okay, it won't allow
Conventional-
renovation.
That's why if you're looking at a home and it needs any kind of work that would make it ineligible for conventional, you would have to go renovation loan in order
Okay.
to try to finance it. But it could also be a home that's a very nice home, but it's outdated. And again, you could use a renovation loan to actually give it updates. There are rules about what type of renovation loan will allow what types of updates and improvements to the house. Some are so extreme that you can have a foundation with no house on it and build a whole new house on that foundation. You can move a house from one piece of property to another piece of property with certain types of renovation loans. So they can go to that extreme, or they can be just a simple thing. I want to do a little bit of paint and remodeling of the kitchen and bathroom in the house, and that's it.
Right.
And that would be, again, there's a product for that that is much easier to go through and doesn't involve quite as many inspections and so forth. The other thing to keep in mind about renovation loans, that the inspector that starts or does an inspection prior to you applying for the loan is there throughout the process.
Okay.
That inspector inspects the work of the contractors to clear their payments,
Right.
to make sure that they did the work that they said that they were going to do so that they can get a partial payment toward that work. They also hold back some money from those contractors until a period of time after all the work is complete, in a way to protect you again. The idea is they want to make sure that none of those contractors are putting a mechanic's lien on the house. And once that period, statute of limitations for them to put a lien on the house is passed, then the lender says, here's the funds for the remainder of the work that you did. And in a way, you can think of it as the inspector and that lender, they're there watching the interest of the lender, to be sure.
Right.
But they're also there, in a way, it helps watch your best interest as well. Make sure work's done in a timely manner, it's
Right.
done to the code that it's supposed to be done to, and so
Right.
forth. Because dealing with contractors on your own, that can be, for a lot of people inexperienced with that can be a challenge.
Right. Well, so the renovation loan then is just available with Fannie, Freddie, and FHA.
FHA, Fannie, Freddie, or Fannie, FHA, Freddie, I believe, but state of Massachusetts,
Okay, so
every
it's a-
state
so
has.
it's a very specialized loan then.
Yes. It's the idea that it includes, for a new purchase, it includes the purchase price of the home plus the renovation. For a refinance, it's the remodeling, renovation of the home, because you already own it, so you're not purchasing it.
Right.
You're simply looking to improve upon it.
Okay.
And again, it's great in that conventional financing, conventional loans do not cover that kind of work.
Right.
And at a time where there are a lot of distressed properties, or
Right.
properties that have been sitting on the market that are beautiful, maybe they have excellent bones, but people they're passing it by because it doesn't look, turnkey.
Right.
It's an opportunity for someone to have a vision and make that a turnkey home that they could then move into. And it's I should point out, it's for owner occupied. This is
Right.
not for investors.
Right.
Renovation loans, investors would hop on this, I think.
Oh, yeah.
It's not for investors. This
Right.
is for folks that plan to live in the home that they're renovating if they don't own it already.
Right. Yeah, you can see where that would be a nice market for investors to get into.
Cheap
Matter of
funds
fact,
to,
I want to sign
to
up
buy.
today for that.
Yes, and you can always, one thing to keep in mind with, I said that they come with certain costs involved. So, for example, FHA with 3.5% down, that comes with mortgage insurance.
Right.
Almost like a conventional would,
Right.
with less than 20% down. But rules changed in April of this year, April 1st. It used to be at 20% equity, 22% max, but at 20% equity, that you could get rid of mortgage insurance on FHA. As of April 1st, it's there for the life of the loan on a 30-year loan. Now that scares people, but one of the things you have to recognize is that you can refinance out of that. So while it might be a a way for you to get into the house now, renovate it, and at least start your life in that home. It doesn't prevent you 2, 3, 5 years out from saying, you know, I want to finance into a conventional.
Right.
I have enough equity, and I'll do the conventional financing, and a private mortgage insurance goes away.
Right.
So even though up front there might be some costs that you go, oh, this seems more expensive to me, you have to look big picture. What are your plans today? What are your plans 5, 10, 15 years out? And again, preparation. What should you be? What are the best decisions for you now that are going to carry over throughout, you know, that period of time that you have in mind?
Right, and I think it's a key thing that you brought up, the PMI insurance, that can be very expensive in the out years if you don't get rid of it.
Absolutely. The key, as soon as you can refinance out of it, why wouldn't you refinance out of
A
it?
lot of people forget, but I think it's a point you bring up because that's almost should be on an annual checkler calendar in your home. It said check your financial status and what are the needs for getting away from PMI. Because PMI is basically an insurance policy.
Yes, and the thing to understand is what you're insuring is you're basically insuring the lender's interest in that property.
Right.
Because when someone defaults, there's a cost associated
Right.
with that. The lender wants to make sure that their interest in that property is protected. You pay for that. And that's standard. That is across the board. There is no lender really that can say, you know, no PM. There are situations where they can do no PMI
Right.
For a particular product.
Right.
But for conventional with less than 20% down, for, you know, FHA with 3.5%, the way that they look at it is the less money you've put into that house, the bigger risk it is.
Right.
You know, and they want to cover themselves on that risk. One other thing I should mention though about insurances is on the title insurance side, when you pay on your closing fees, you'll see title insurance. That title insurance is the lender's title insurance. It's the lender, you're paying for the lender to be insured against any issues with title. You can obtain your own owner's title insurance separate to protect your interest in your investment should any title issues come up down the road.
Right.
So just be aware that you know, the default insurance that you see on your closing is actually the lender's portion of that. That is your responsibility.
Right.
But that you can go and obtain your own insurance, and it's not expensive compared to what it could be if you run into title issues later.
Right. Well, there was one point I was going to mention insurance, but it was basically from a homeowner's insurance. There's a lot of different policies you can get, a lot of different coverages you can get, and we certainly don't want to dwell on it too much, except for the fact that it's very important to have the proper coverage on your home and you to understand what your deductibles are. And, you know, like you may have a home that you bought today and you figure it's worth X amount of dollars, only to find out your policy only pays you about 30% or 40% of what you thought it was worth because you don't have 100% replacement policies. It's a whole other discussion, I would assume. But is there any Cliff Note type thing that you could leave our residents with on insurance?
A couple things. One, if you're buying a home, when you're approved, pre-approved, insurance is one of the costs that's calculated in. That lender is approximating. They don't know which house you're going to necessarily pick.
Right.
And they try to approximate that insurance. What's important to note is if I were doing a workup of paperwork and I said, I'll accommodate, you know, $1,500 worth of annual insurance premiums in, and you seek a policy that costs $3,000, that changes your numbers. That could actually render you ineligible for the financing. So you need to understand what number that lender used for calculations and either stay within that number or ask them, hey, I found a policy, here's the coverage, I like this company, and you know, how's this going to affect my numbers before you go and obtain the policy? Because if you obtain it and come back and then it throws all your numbers off and nobody was expecting it, that can cause an issue with your eligibility. The second thing is, remember we were talking about property in the last episode, the different types of property. Just keep in mind, a home has inside-out insurance, all the property, and depending on where you live, you might want to make sure you have wind coverage or flood coverage and so forth. But on a condominium, it's walls in. So while the homeowners association and the fees you pay to that homeowners association cover the exterior of that unit, you want to still obtain, and you'll have to obtain, the walls-in policy for yourself. So you're effectively paying for the complete insurance, but through two different avenues. So depending on the type of property, that can play a role in what type of insurance you need to obtain, and making sure you have enough coverage. Last thing you want is to be caught with, in a flood, let's say in a particular situation where your house is flooded and you didn't have flood coverage.
Or you didn't understand what your coverage was.
But generally they'd catch that up front, because you can actually look. By the way, you can look online on FEMA's website and see flood zones. So you can actually look up an address before you even entertain buying the house and see if it's in a flood zone, so that you can determine, wow, do I really want to incur the cost of flood insurance for that house? How much is that going to cost?
And you might want to remember or remind the residents of Longmeadow that flood zones are changing. As this global warming takes effect, the flood zones are actually starting to change across our country, as with the temperate zones are changing. So it's another factor to be aware of, because if you're right on the border of a 100-year flood line today, 10 years from now, you may actually be in the floodplain.
Absolutely, and we have seen situations where someone was using the flood boundaries that they were on record prior as their determination of whether or not they were in a zone. They hadn't checked, in other words, for any changes. Come to find out, during the financial process, so this is someone who's already done a purchase and sale agreement. They're trying to obtain financing. They're in a flood zone now. Now you've got that cost. That cost has to be rolled into their calculations, and the question is, will that throw them out of eligibility? And what can be done? What manipulations can be made to the numbers? Maybe more money down on the house, like a bigger down payment, whatever it is, to accommodate, to offset that change in their numbers. So,
now, I was thinking a good adjunct section to this is to have a realtor sitting here, and we're talking about, from the other side of the perspective, on finding that right house and all the key points that they can talk to you about on when you look at a shell in a home and make the right decisions. But there's another point I wanted to just briefly touch on, and it more or less deals with the either uninformed or underinformed homeowner that gets a knock on the door with somebody wanting to sell you a roof or sell you windows, or these types of deals. Now, most homeowners would be not technically prepared to enter into that discussion, and there can be some high-priced sales routines. There can be some vendors that aren't really totally scrupulous. I mean, they can ask for 75% down payment, and you never see them again. What can you generally offer in just an encapsulated statement to the general public on where's to beware?
The first thing is that in the past, I've made the mistake of going with, they had an attractive low price, and you go with that particular contractor. Come to find out, they're not licensed or they're not bonded, and you have no recourse. And when they do a job that's substandard, they could simply walk away, and it's very difficult to now pursue them. It would cost you probably as much in legal fees just to try to pursue an individual like that. So why entertain that to begin with? You find yourself, there are a lot of resources, Better Business Bureau. You can even look on the Secretary of State's page. For every state, they have a corporate search where you can search on businesses. Is it a legitimate business that's actually registered in the state that you're in? Are they licensed? Are they bonded? Get references, talk to their references, go see their work. When we had tile work done, we were able to see the work that individual did before we had our own work done, and gauge whether or not we even want to begin working with this person. The folks that approach you at your doorstep, well, I cannot say with 100% certainty that they can't be trusted. They might be a legitimate business that you could look up online or get references, and it turns out great. You just have to be aware that, if they're not licensed, if they're not bonded, then recourse is just, it's more difficult. You're making things more difficult. And being able to check their references, not just a phone call either. I like to see the work in person if they have a previous customer that's willing to show it to me. And then making sure don't give them large portions of the fees up front. Make sure you have a written contract with them that outlines all the work in detail that they're going to do. We worked with a painter who told us how many coats of primer and how many coats of paint. That way, there's no ambiguity.
Right.
And it works both ways. That contractor can then say to you, well, you had me do 2 coats. You want 3 coats, that's going to cost you more. That can happen as well. But that contract is an important reference for everyone involved, and making sure that you offer up payments on milestones. I check to see that this much work was done, great, I'll release this much payment to you, such that you're certain that they're motivated to actually do the work and not walk away. Right. In terms of upfront payments, I've never ever paid more than 50% upfront, and most of the time I like to negotiate. I'm a tough negotiator, and I'd rather pay 10-20% upfront and go from there. The thing that you definitely want to avoid is putting yourself in a situation where you've already given away the bulk of the money that they're going to earn. They're not going to care about the last 20% necessarily.
And I think that's a good point.
Yes.
Because pricing can be arranged that they can walk away from 20%.
Absolutely.
And folks, you have to understand, we're not talking about reputable contractors, people that you know. We're talking about the cases where people get scammed accidentally by, there's always somebody trying to make a quick buck. And it does happen. It can happen in our community just as easily as any other community. I remember that I was down in Virginia, and there was crews that was notoriously coming out of Tennessee, pickup trucks and Bowsers full of driveway sealant material, which a lot of times was nothing more than paint and waste oil and mixed all together, and it really was nothing. And they would come in and do this job, and they were gone. They'd take your money, and they were history, and you really just didn't get anything. You basically got black paint put on your driveway. So there's all kinds of things that could be about. I guess I'm just trying to put out there to be aware. It's like the old thing, if something sounds too good to be true, it's likely not true.
Sometimes when you hear pricing that's so attractive, for example, if one vendor tells you it's $4,000 to do the tile in that room, and another vendor tells you it's $1,600 to do the tile in that room, I'm not saying that it can't be done for $1,600. What I'm saying is be aware that that might be different materials, that might be totally different craftsmanship, that might be an individual that there's no recourse if they don't do the job that they planned. So you are actually out the $1,600 and have to go to a reputable vendor later anyway to now pay them to rip out all the work that was done incorrectly and redo it again. So sometimes it just pays to pay a little bit more upfront and have it done right the first time. And especially with someone with a history of, let's say, warrantying their work. Right. If they have references that said, John came back 6 months later and he helped because that tile cracked and it shouldn't have cracked. Fantastic. That's a great reference point to use when you're considering working with that particular contractor. Right. Because some people, the moment they leave your house, they don't want to see necessarily ever again the work that they did. And others, they look at it as a long-term relationship. If I do a good job now, for example, when we hired the painter, he worked on multiple projects with us because every time we were able to say, wow, you did a great job. We're going to bring you back for another one. So there are a lot of folks out there that, they do a great job, but always make sure, contract, not verbal, make sure it's written, that details the work they're going to do and the amounts they're going to be paid and at which point in the schedule. And the only other thing about that is make sure that it lines up with their work schedule. Nothing worse than planning, let's say, someone to do tile in your room next month and come to find out they're going to be on vacation 3 weeks of that month. And you didn't know that never came up in the conversation. You want to make sure that that they're going to be able to do the work on a predetermined schedule.
So I guess it's not so much buyer beware, it's buyer educate.
Always,
I think that's the
always.
process. And look out for some of the things that, we've mentioned at this table, some of the very obvious signs. If somebody wants 75% payment in advance of starting the work, I would stop dead in my tracks and look for other contractors, or I would gain additional advice, because that's something that is well beyond trade, as far as I'm concerned, well beyond trade expectations. But there are reasonable charges. If a person is going to buy a product and have it delivered to your home, they're certainly entitled to some money up front to have that product delivered to your home, because they now have an investment going on. But I think we hit on a lot of it, and it sounds like we went to the dark side of this, and we did a little bit, because you can't have an open discussion on this without talking about the fact that there are some events that take place in life that are a little bit on the dark side.
And it really comes down to awareness, education, taking the time to, whether it's online or I prefer, as we've mentioned multiple times, any kind of workshop that you can get current information, up to date, accurate, in dealing with whether it's financing, contractors, what have you, versus relying solely on information that you see posted online that really isn't relevant necessarily to your particular circumstances.
Yeah, check with your neighbors. If you see a service
That's a
truck at
great-
your neighbor's home and you've seen it there for
Great
a couple of
reference.
years, go over and ask them, because there's somebody that you can absolutely trust 100%. Talk to somebody that you know is a stickler on repairs in their own homes. And if they have a contractor coming in and doing repairs in their home, you know the work is being done right. I guess it's these little things. Just be aware that sometimes it's best to double check twice before obligating yourself. Now, you mentioned the Better Business Bureau. Is there any other consumer advocate groups that you can think of readily available where people could gain advice from?
Some of them require fees.
Yeah.
So, for example, there's Angie's List. I've never personally used it, but apparently, it tracks vendors and provides feedback, but there's a fee associated with it, and I've always been uncomfortable with that part of it. But there are resources like that. In terms of free resources, I rely primarily on Better Business Bureau, references from people that I know.
Right.
Maybe it's in my town, or perhaps personal friends, colleagues, coworkers. And then also things like the Secretary of State for your state has information at least on, is that business registered in the state? Because that's important. If someone's basically operating as a willy-nilly fly-by-night operation, they're not going to show up either on the state's radar or on your town's radar.
Right.
Because the town would even have, in some cases, records of whether or not that business exists.
Right.
So making sure that it's it's on the up and up, and that helps everybody involved, particularly from a recourse. When not to I know this is more the dark side of it, but when there's always that avenue for recourse, people tend to be keep things all on the up and up, because they know that, well, I need to make sure that this is all done correctly, so that it doesn't come back to me. And but most vendors out there, there's a large number that's how they operate every day. They want you as a long-term customer.
They want your reference.
Absolutely.
Yeah, especially they want you as a reference. And there's another thing too. You have to understand, even if you have the best possible firm in the world, during the last 5, 7, 8 years, there's been a lot of really great repair firms that didn't make it through the recession. And they may have done work, and you thought they would be around for another 25 years, and they're no longer here. But that certainly shouldn't sour you against using local, recognized, good quality vendors. That's just the economic times have happened.
The thing I like about local, besides the economic benefits of kind of contributing to the local community, is it's a heck of a lot easier for me to go either see someone's work or to speak with someone who's had work done in that local area. And it's generally, I think it's just nice to know that person is right there down the street. For example, plumbers and electricians that are within miles of where I live, that I call them up, I need a pipe fixed. They're not coming from 4 towns away, they're coming from within town. And yes, there are going to be times where their price might not be the absolute lowest price, but I look at the long-term relationship
Right.
and the fact that they're willing oftentimes to bend over backwards for me, even though I'm paying a few more dollars for the service that they provide.
I think it's a good point. So we've had session 1, we've had session 2. What are we looking for in session 3?
Want to go over the roles and responsibilities, particularly on financing, but we'll also cover on the home buying side, realtors, attorneys, appraisers. There are a lot of important points that we weren't able to get to in the first 2 sessions that I think it's important for people to understand, for example, what their relationship is with an appraiser or with a home inspector. Who is the underwriter and what role do they play in someone's financing? So I want to step through each of the roles and help everyone understand who these people are, what they're there for, and how best to leverage their expertise to make that whole process smoother and less stressful.
Okay. Well, Joe, I can't thank you enough for coming in, and I feel the exchange between us and to the residents of Longmeadow is positive. I think there's been a lot of positive things brought out on the table. And excuse us, we went on the dark side a little bit, but I think you can't have a discussion without talking about everything. It always doesn't work the way you want it. And in the interim, we'll have enough time to have the sessions out, session 1 and session 2. And hopefully we will have some questions that come back from the residents that in the third and final wrap-up session, we could have a Q&A session that would address certain subjects.
Would love to hear anyone that has questions and wants to email either of us. I'd love to be able to answer. The one thing I want to avoid, though, is anything that's specific personal in nature.
Right.
We can answer general questions, but anything personal, there are lots of regulations about revealing any of that
Right.
Over the air. So we want to make sure we keep it to general questions.
Okay, and we mentioned before, I have an email address. It's rfoster@longmeadow.org. And Joe, your email is
joe@movingonup.org. It's MOVNONUP.org.
And we failed to mention on the first session, in case you didn't have a piece of paper and you wrote down our email addresses, you could always drop a line to the station. They have a contact point on their website, and you could get information to either Joe or myself at this point. And if you get it to me, I'm likely going to funnel it to Joe for a Q&A session that'll be coming up. So, Joe, I appreciate you taking your time this morning. We've actually filmed 2 sessions today. We've done 1 and 2 today, folks, even though this is number 2. So thank you once again for your time.
Pleasure being here. Thank you for having me.
And thank LCTV for taking the opportunity to film these public information sessions. We have a great radio or a great TV station here in town. They have a dedicated interest in educating and enriching our community, and it's greatly appreciated. Thank you.